Good afternoon, everybody. Thank you for joining us today. Welcome to the Dialogue Series, AASB Dialogue Series on Accounting for Grants, What Might Be Missing. My name is Sabine Schürer. I'm a Senior Manager here at the AASB. And as usual, I'll start with some housekeeping first. So the AASB Dialogue Series is jointly held with CPA Australia and CAANZ. And the views shared in these sessions are the presenters' personal views and not those of their organizations. I would also like to encourage the audience to participate in the dialogue series via the Q&A function. So if you do have any questions, please post them in the Q&A function and we will address them as we go or at the end of the session when we have more time. The session will be recorded and will be made available on the AASB website. So as I mentioned, today's Dialogue Series event is on grant accounting and more specifically on grants received. So from a recipient's perspective, now grants are very economically significant. The Commonwealth alone provides grants to the state, territories and local governments of approximately $2 billion. And then, of course, there are grants that go to the private sector as well. And we'll hear a bit more about that from Dr. Wei Shi, who will give his research presentation in a short while. And also the Australian Charities Report reports that around $118 billion are provided from government grants and government funding, and just under $15 billion of donations and bequests. So it's a very important area economically. And again, just to set the scene a lot from an accounting perspective, we've got two standards in Australia, one that applies in the for-profit sector, AASB 20, accounting for government grants and disclosures of government assistance. And then we've got our not-for-profit standard, AASB 1058, income of not-for-profit entities, which is applied by both the private and public not-for-profit sector. So with that, I will hand over to Dr. Wei Shi, who will present his research on a change of accounting regulation in China. And Dr. Wei Shi is a senior lecturer in accounting at Deakin University with a research focus on information flow in capital markets, ESG, and the economic consequences of accounting regulation. Wei has published widely in leading journals and is an associate editor also for the Journal of Contemporary Accounting and Economics. So please, Wei, I hand over to you.
Thank you, Sabine. Can you see my screen? Yes. So today, good afternoon, everyone. Today I'll present on the real effects of reclassifying government subsidies, evidence from China's 2017 accounting standard change. So the presentation is based on a working paper with scholars from Canada, UK, and Hong Kong. So this study examines how a seemingly technical change in presentation could actually influence investor perception and also real capital allocation decisions. So let's begin with the broader context, which Sabine also mentioned. There is actually a surge in the industrial subsidies provided by the government to protect the employment and also promote innovation and also favor the national priorities. So this graph is taken from the OECD Magic Database, which closely monitors the global industrial policy. And we can see that the subsidies reached the highest level in 2023 to 24 since the global financial crisis. And turning to the research setting in China, we also see that there is an increasing trend of government subsidy. So this plot basically talk about from 2010 to 2021, there's an increase in the number of companies receive government subsidy as well as the total amount. Actually, by 2021, the average government subsidy grants reached about 14 million US dollars. And this grants is similar to what I mentioned earlier. They try to promote innovation or try to stabilize employment. So this magnitude of the government subsidy, both in China and also globally, underscores both the economic importance and the potential materiality of how these numbers are presented in financial statements. Let's turn to the accounting framework for government subsidy. So in IFRS, the IAS 20 is the one that governs how companies treat the government subsidies in financial statements. The Australian equivalent is AASB 120. So basically, if there is a reasonable assurance of compliance and receipt, the companies can recognize the government subsidy in financial statements. For income-related grants, they will be recognized in income statement as other income, or they can net against expense. And for asset-related grants, they will be recognized as deferred income in the balance sheet. For the US, historically, there is no explicit accounting standard for the recognition of government subsidy, but recently the FASB issued the accounting standard update 2025-10, but that would be effective from December 15th, 2028. That standard basically aligned closely with IAS 20. So basically, we can say that IAS 20 is the major accounting standard globally for the recognition of government subsidy. But from the research perspective, if we would like to examine the economic consequence of this accounting standard, we would like to see a change. But unfortunately, when companies adopt IFRS, they will adopt the whole package of IFRS, not this individual accounting standard alone. So it makes it empirically challenging to single out the effect of the individual accounting standard. And this is why we focus on the Chinese setting, where we can single out the effect of this individual accounting standard on IAS 20. So now let's talk about the change in China. So basically, when China converged to IFRS in 2007, there's actually some divergence from the IFRS, with the government subsidy being one of them. So before 2017, which is about 10 years later after IFRS was converged in China, the government subsidy for the income-related ones, they can only be recognized below the line in the income statement. But after 2017, the companies have the discretion to recognize the government subsidy in the income statement above the line, as long as companies can justify those income are related to their daily operations. So this change actually could facilitate a before and after comparison while holding the underlying economics unchanged. So this table basically is about one of the companies in China, and we can see that before 2017, there's no such item called other income, but this item appeared in 2017 income statement, basically to specify the government subsidy. And we can see that the operating income, which is called earnings, that increased noticeably, largely due to the recognition of income-related government subsidy as other income. The company also provides the final report that decomposes the government subsidy item. And not surprisingly, actually, most of the companies exercise this choice. That is, they recognize the income-related government subsidies in the income statement as other income, which is above the line. And we can see that for the deferred income, which is recognized in the balance sheet, it did not experience a significant change. So this potential change actually make the income-related government subsidies more integrated with the core operating performance. So one of the natural questions would be, what is investor perception? So we actually find in the online investor forum or the investor interaction platform, the investors get confused about why there's a change in these extraordinary items, which typically capture the government subsidy. And also in the investor discussion forum, there is a chant talk about when the income-related government subsidy being recognized as operating income. For those unfamiliar with the accounting, may mistakenly believe the company suddenly made substantial profits. And if they apply a valuation multiple, for example, the P ratio, they could place a high valuation of those firms. But this is come to the critical point of the government subsidy. That is, are they as persistent as the core operating income? And we argue that this is not the case because the government subsidies, they are exposed to the political and the policy risk. They are subject to the government changes, budget pressures, or the shifting priorities. And consequently, it will be temporary or conditional, and the government retains the discretion to modify, reduce, claw back, or even discontinue the subsidies. And we can see that in the US, under the recent Trump administration, two companies, Intel and also the Wolfspeed, they companies express the uncertainty about the timing and the finalization of the government subsidy due to the policy transition. So when we take this observation into the data, indeed, we actually find those firms that are more exposed to the government subsidy standard change, they actually experience a significant increase in the overvaluation. And this effect are more pronounced when the subsidies are less persistent, or there's a higher retail investor participation, or if firms provide low quality subsidy related disclosure. So in other words, this accounting presentation change actually leads to a temporary overvaluation. And this kind of overvaluation actually also have a real consequence for the capital allocation. We found that for those firms more exposed to the government subsidy standard change, they increase their investment, but they suffer in terms of investment efficiency. So in sum, actually, we found that a technical accounting change will lead to the investor misperception of the persistence of the earnings, which eventually distort the capital allocation. We have some implications for the practitioners and standard setters. For the sake of time, I'll talk about the standard setters perspective. So basically, what we find here is that a similarly technical presentation change could actually alter a reality. So it's very important to mandate the persistent signaling and also prioritize the investors' education alongside the rule change. In sum, our research showed that the presentation could shape perception, and also perception shapes reality. So thanks for your attention. I'll stop here, and I look forward to a rich discussion on the implication for account standard setting in the area of expanding government subsidies. Thank you. Over to you, Sabine.
Thank you very much, Wei, for this very interesting presentation. So you've highlighted really the role of or the impact that accounting changes can lead to, and also the importance of having relevant disclosures so that users can actually understand what is really happening. I'm sure the panel would like to reflect on that presentation. So I will introduce the panel first. In alphabetical order, we've got Amir Ghandar, who is the reporting and assurance lead at the Chartered Accountants Australia and New Zealand, and a regular, of course, in this dialogue series. We also have Michelle Harrison, Director at the South Australian Department of Treasury and Finance. Michelle also represents the South Australian Government at a National Advisory Committee, HODREC, and chairs CPA Australia's Reporting and Assurance Centre of Excellence. Fridrich Housa, my old colleague, is now the BDO's Leaders Australia's IFRS and corporate reporting technical assurance team, and brings with him extensive experience in standard setting, and worked previously at a major Australian bank and not-for-profit organizations. And last but not least, we have Martin Lawrence, who is the co-founder of Ownership Matters, who has over 20 years of experience in governance and accounting research, and will bring his analyst perspective to today's discussion. So reflecting on Wei's presentation, I think we might continue with the for-profit perspective. So Amir and Martin, what are your observations with regards to the research presentation that we've just heard? And also then, what is your experience with grant accounting in the Australian context?
I'm happy to kick off from here if that's all right.
Yes, please do.
I'm not surprised by the findings. If you talk to people in financial markets, they will often say, "Well, just disclose more, and we'll work it out." There's a lot of research, mostly out of the US, but elsewhere, that no matter how much investors say, "Well, we look past so-called street earnings to, the reality," that street earnings are enormously influential. And so I'm not surprised a change that allowed you to take as, operating income a government payment that may or may not be long-term recurring got encapsulated into accounts. Certainly when there's an accounting change and periods of accounting change, if you'll talk to any participant in financial markets about the impact of the lease accounting standard, create a great deal of confusion amongst investors. General experience, I would say, in the Australian context of people under the framework we have, the big test was COVID. Like, that is when you saw an enormous amount of government subsidies. JobKeeper went to an enormous quantity of listed entities, but there are a lot of other bespoke incentives that were created, both in Australia and offshore, that affected listed entities in different ways. And I'd say most companies were pretty upfront in how they reported them. And most but not all, I think investors were able to look through. And in a lot of cases, I think that's because companies went to great lengths to draw them to investors' attention. Because I think most of them were keenly aware how distorting the scale of a subsidy was. The company that actually received, I'm pretty sure, the most government subsidies during that period, which was Qantas, it actually had very little impact on their presentation of their numbers because they had almost no revenue. And so no one was really looking at the numbers anyway. They were looking at the balance sheet and nothing else. But by and large, I'd say Australian entities in the recent big test, which was COVID, did a pretty good job of being upfront. And investors, because companies were very upfront, um, were able to look through it. There are a couple of notable exceptions. Some companies that just didn't report. Didn't itemize government subsidies they'd received in their accounts. There was one listed entity, Credit Corp, which did not disclose it had received JobKeeper until Parliament mandated disclosure of JobKeeper in a separate ASX announcement. And they also did not disclose the existence of a loan they had received under the US Paycheck Protection Program, which was material in the context of profit. Now, you could find that because the US required mandatory disclosure of it all. But I'd say by and large, the framework on the big test that Australia had passed reasonably well. And I think investors were by and large didn't get too much false exhilaration of how well companies were trading as a result of the impact of government subsidies.
Yeah, I think that's a really interesting point, actually, Martin, and Dr. Wei Shi. Very interesting presentation and a useful kind of lens that you get from that controlled experiment with those specific changes that were made. It does underscore the challenges that we've seen in Australia in applying the standards, which I guess in a nutshell are as a result of this being from quite a different conceptual era than the way income statement works elsewhere in the financials under 15 now. More of a matching type approach as opposed to obligations and delivery. The second really is the judgment that's involved as a result of that. And I think that brings you back and the wider parameters for how you disclose things or not disclose things. And yeah, I do think to Martin's point, COVID was a very big test. But then again, in some ways, COVID was a little bit like the test where the teacher kind of stands up at the front and says, "Hey, this is happening, everybody. Don't fail, and here are the answers," right? Because you really no company was unable to make a very obvious excuse as to whatever was happening in performance, and they wanted to highlight this. I think the more worrying piece probably is outside of that kind of very broad-based sort of subsidization of the economy. How are how are the fringe cases kind of coming through? And I do think that creates a lot of pressure on auditors because they need to really challenge the accounting, and when you're dealing with this type of accounting, that can go right to the heart of what standard you're actually using, depending on the arrangement. And then, if you are in 120, quite a wide set of, judgments that can result in very different outcomes, both from a measurement and disclosure. So it's probably more those cases that aren't as obvious and, universal as COVID was, where it can be very challenging, and you have to wonder whether that is sort of still at the right place on the spectrum of judgment versus prescription and just the overall approach that's taken in the standard in its modern context now.
Thank you very much, Amir. You've mentioned sort of there are some challenges with the application of 120. I don't know, do you have any specific examples about those fringe cases or where we are not sure about the scope, and then also some transactions maybe that are outside the scope?
Yeah, look, I think it all has to do with the sort of, restrictions that may be involved in a contract, the timing, when funds are received, and if it's, received at a certain, around the year end, and then the way that the contracts are framed. those can result in a very different accounting outcome. And then this, not that we like prescription, no, we love prescription. We love principles, right, in accounting. But of course, 15 pushes you down a much more, if you're dealing with income, a much more clearly prescribed approach for a number of particular cases. And in some of those cases, we look at it and go, wow, that doesn't make a whole lot of sense. But at the same time, at least you know what you're dealing with in that case. I think it's always going to be a spectrum between conservatism or aggressiveness in accounting and between, for standard setters, between really more specifically prescribing the approach versus leaving, open judgment to present the information in the most meaningful way. Of course, they can't anticipate all of the various different ways that transactions are going to be structured. However, at the heart of the challenges is that wide degree of judgment, and then where you have for example, timing of the payments versus the other aspects of these arrangements that don't easily fit into a particular financial year or fit the criteria for applying 120. You can end up in many cases, probably more than other standards, much more than other standards, in a situation where it's difficult to land on a clear judgment. There can be reasonably argued cases on different sides.
Mm. And that sort of leads us to some of the feedback that we've heard from constituents before, that AASB 120, being an older standard, is not really aligned with the new conceptual framework principles and the principles outlined in AASB 15, as you've heard. I don't know, Martin, whether you wanted to add anything, your observations of the current AASB 120. Are the disclosures sufficient for you to understand, from an analyst perspective, the impacts, the timing of the recognition of the revenues, etc.?
I was actually just thinking when Amir was talking about stuff that isn't captured, and I mean, a very notable recent example that was affecting two large listed companies, AGL and Origin, was various government utility bill relief schemes, where the company was effectively acting as an agent, but was receiving these huge washes of cash through their accounts. So these are not companies that are principal agent accountants, right? They're not like a travel agent. Again, in both cases, they went to enormous lengths when talking to their investors to try and point out, hey, this huge bump we've had in our cash flow, that's not because we're doing really well. And that, I would say, was rational self-interest, because they didn't want to then have to explain why all that cash had disappeared later on. You have seen some other one-off stuff around subsidy of coal purchases or coal price caps. New South Wales government had. And again, there you're relying on companies disclosing, because I think, to Amir's point, the limitations of the standard, I went back and reread it before doing this, and I had set aside a lot more time than thought I would need, because for an accounting standard, it is really short, showing its age. And it is very clear that that when companies and their auditors are looking at some of the types of grants that get structured, which are often quite bespoke and unusual, trying to fit them into this framework is difficult. And so I'd say more guidance is probably helpful to both practitioners and users in the end event. I was also just chuckling when Amir was talking about transactions and aligning with AASB 15, the Australian defence contractor Austal, who manufacture patrol boats, amongst other things. A couple of years ago, they got this enormous contract from the US Department of Defense for a combat shipbuilding program. And it was pretty clear, because the terms of it were so loose and they were paid the money up front, that they had literally no idea how to account for it under either. Ostensibly, it's revenue, right? Because it's for something. But they got the money up front with no real conditions. And so they actually sort of said, look, we've got all this cash. We don't actually know how to treat it from a revenue perspective. They eventually came up with a way, but yeah, it was even non-government grant government payments can sometimes cause a lot of challenges about recognition.
Thank you, Martin. And that really sort of is one of the main differences between AASB 120 in the for-profit sector and then what we've got in AASB 15, the principles of 1058, where it's really about the timing of when do we recognize revenue, right? So, so I think that's probably a good point to lead to the not-for-profit sector where 1058 applies. So essentially, we've got these two different accounting standards that are applied on different sectors. And my first question is, are the objectives of reporting on government grants or grants different in both sectors? Michelle, I might just throw that question at you.
Yeah, sure, Sabine. Look, it's sort of difficult to pinpoint whether the objectives are different, but certainly the outcomes that we have for for-profits and not-for-profits are very different. So under 120, you're seeing much more of a matching principle being applied in terms of when the income is recognised. It will largely align with when the expenses are being incurred in fulfilling the requirements of that government grant. We have a different model which applies to not-for-profits. After considering whether the funding that they receive is in fact a contract with customer, they will go to AASB 1058, and then that applies a control model of when you control the asset that you are receiving, which will ordinarily be cash. We also see some differences, particularly in how grants related to assets are accounted for. So under AASB 120, you've actually got some choices there. You can choose to spread the income as you use the asset, so over the useful life of the asset, whereas, or you could alternatively deduct it from the cost of the asset and have reduced depreciation expense, again, over the life of the asset. Whereas by contrast, AASB 1058 takes us to recognising the income from the grant as you acquire or construct the asset which that grant has been provided for. So a far more compressed period compared to what we see under AASB 120.
Thank you, Michelle. Yes, so that's really the key difference, right? Is that timing of that recognition of revenue. And the question then, of course, is, well, should there be a difference really with very similar transactions? So just because you're in a different sector, should there really be a difference? I don't know, Freddie, whether you wanted to add something here as well.
Yeah, no, thank you. Thanks for having me, and thanks, Dr. Wade, for the insightful presentation. And before I go anywhere further, I think you mentioned that any views I might represent or present are necessarily video views. So just quickly reflecting, I think I concur with the sentiment expressed today so far. 120 is old standard, but thanks that we have it, right? Because it was heavily used a few years back, and obviously there are transactions where it's at least used, if not directly, then in an analogy, and whether it's RD tax offsets and or even the carbon credits, etc. So it has its place. And when I was looking around what happened in this area, obviously FASB, US GAAP actually, and I think Dr. Wei mentioned that, got inspired by that standard. So it has its merit, and we have number of transactions for which we still don't have standards, and that's probably tougher spot to be than to have a standard. Now, while I'm talking up AASB 120 is also the fact that there are some downside or maybe deficiencies because it's old, conceptually maybe lacking a little bit, and or there are some choices, a number of choices there will be some stakeholders that will actually don't mind that those qualities or those characteristics of that standard. And also, if we compare, and I'm getting to then AASB 1058 and 15, if you would ask many stakeholders, especially in not-for-profit space, which philosophy of the accounting or recognition of grant they would prefer, I'm not sure whether they would land in 15 and 1058 space. They will probably actually land in 120, whether they will call it 120 or not. So that's where I would kind of kick off on that comparison between for-profit and not-for-profit. Obviously, in Australia, we have that additional challenge that we have transaction neutrality principle. We are adopting IFRS and then adopting them, tailoring them to the needs of not-for-profits to the extent we need. And that presents with challenges because we can talk about 15 and how it's applied in not-for-profit sector and what are the challenges in the next segment. But I think that's where the sticky points are. And I think the question is, which one is better? And for whom? Going back to that objective is, I don't recall we have such a significant differences in conceptual framework in regarding the objective of the financial reporting between for-profits and not-for-profits.
Yes, thank you very much, Freddie. I think you raised a very important point that our objectives they're really to inform or provide information that is useful for the users, right, for decision making. And as you said, they might not be all that different across the sectors when it comes to grant accounting. But you mentioned some of the challenges in applying 1058. Could you maybe elaborate a bit on those?
Yeah, thank you. Well, I would actually probably start with 15 because we do focus on 1058, but it really is as you know, it's a residual standard, or at least that's how I would characterize it, and I think it's in BCs somewhere. And so the challenge actually really starts that when we are thinking about, let's talk about grants because the session is about grants. The entities actually need to decide, what was the starting point? And there is also still a little bit of confusion where to start. And then ultimately they can actually waiver and go from standard to standard depending on the characteristic of the transaction. And before I will get to 1058, I think the challenge is also in 15. Let's not forget about that. And the contracts are written in different ways, and especially in the not-for-profit space, those contracts are not necessarily written as commercial transaction would be, and therefore to identify those sufficiently specific performance obligations is a challenge, and they might be there, they might be not. The principal versus agent concept is definitely present in not-for-profit space, and so I think there is some work that could be done still with AASB 15, and then obviously with the 1058. So I'm not sure whether we'll talk about it, but I do know that there was a post-implementation review of both standards, and I think, correct me if I'm wrong, board said as reflecting on the feedback that whilst the standards are largely working as intended, there's still potential, and I would call it hope, that at some point after, I think, considering some projects, they will come and relook at both what can be done. Now, flipping back to 120, if something happens with that standard, that could also help Australian effort to do something with them. Then moving on to the 1058 specifically, I think it's the interaction with other standards, but I think bigger one is that outcomes that result from application of 1058, where depending on a transaction, there will be stakeholders out there that will have a view that application of 1058 may actually distort reporting of performance, because in many cases it may actually recognize too much income revenue upfront, which is not necessarily in their mind reflection of the true performance or delivery on objectives of the not-for-profit entity. And I think especially in an environment where you have 120, which is actually delivering potentially different results on seemingly same transaction. I think that's the gap too wide to jump over for many stakeholders in community.
Thank you very much, Freddie. It's all very interesting. Michelle, do you maybe have some examples from the public sector about these challenges?
Sure, thanks, Ben. And I concur with Freddie that a lot of the challenge is working with 15 and understanding whether that should be applicable. And 15, one of the absolute strengths with 15 is just how legalistic it is in its drafting, and how and it's very well suited to efficient marketplace sort of concepts being applied. That isn't necessarily the way that all grants are being drafted, and we do need to go through considerations which people applying 15 will be familiar with, and identify whether the promises are sufficiently specific to be a performance obligation. That is something which can take a lot of time and care in considering any arrangements. But also things which can be challenging in the public sector is considering whether the recipient of the grant is a customer. And sometimes there might be some legal boundaries where it's not necessarily clear that a grant is being provided in a customer context. It's more to support an entity in its overall objectives, with some boundaries around how that might be applied. So it could also be that the application of 15 gets complex in that way, from that element of whether or not it's a contract with a customer. And we do have Appendix F in AASB 15, which was drafted domestically to help apply the terminology and the concepts in a not-for-profit context. And that goes a long way to helping us understand how to translate some of those concepts of legally binding and those sorts of things, and to get that application happening as best we can. I think that is a key challenge, is working out whether or not you're in 15 at all. And then heading into 1058, there are some challenges there as well. Some of those challenges, again, relate to capital grants, and particularly when we're receiving grants in arrears, not in advance, and how exactly that works with all the words in AASB 1058 has taken a bit of time and effort to work through. And certainly some of the information provided by the AASB through staff FAQs, which, although it's non-authoritative, has been really helpful in applying the standard. So, again, the feedback which we saw from the post-implementation review, a lot of that was around providing guidance and assistance in applying that professional judgment and translating these concepts to situations where the circumstances might not be so clear-cut as we can see in the private sector.
Thank you, Michelle. And yes, what I also wanted to mention, Freddie, as you said, so there was indeed a PIR by the board in which I think finished in 2024, where the board did say that they might be considering this further. But in the recent agenda consultation that we've just undertaken, the board said that we will monitor this at this stage and await some of the other developments, for example, implementation in New Zealand, where they have the IPSAS standards, right? And of course, the AASB has recently published their revenue standard and also the expense standard. I don't know, Michelle, I think you could maybe give us a bit of insights into the AASB standards and the New Zealand experience.
Yeah, sure. At a high level, I'm not being a practitioner in AASB myself, but yes, New Zealand does apply AASB standards in a way that we don't do here in Australia. And at the time that AASB 1058 was being devised, the key standard under IPSAS was IPSAS 23, which dealt with those concepts of reciprocal type arrangements, which many people might recall was how we used to think about income under AASB 1004 before all these standards came in. But from the 1st of January this year, IPSAS 47 has been issued, which it is interesting how closely that has ended up aligning with IFRS 15 for certain elements. So they have this concept of whether or not there's a binding arrangement. And if you have a binding arrangement, then you'll find yourself applying accounting along the lines of what we see under IFRS 15 or AASB 15. And then with your non-binding arrangements, it's similar to the control concept we have, but I think, again, there's a little bit more latitude in how the revenue might be spread, which might be a little bit closer to 120 in some ways. So that's an absolutely brand new standard. So it'll be interesting to see how they go in application. The concept of binding arrangement, again, it's not 100% aligned with what we have here in Australia, but it's similar. So we'll certainly watch with interest.
Thank you very much, Michelle. And Amir, I don't know whether you also have some insights from professional bodies perspective.
Yeah, I mean, certainly not necessarily on application of 47, but 23 is really worth thinking about as we sort of consider how to address some of those challenges of 1058 in Australia. Look, I think just circling back slightly to 1058, I think just because the standard is working as intended doesn't mean that it's not really challenging. And it's probably similar challenges when it comes to the accounting in New Zealand, in not-for-profit entities. So that in New Zealand, it's interesting because they not only apply the IPSAS standards for the public sector, but also not-for-profits. And some of the key things there that are challenging are similar. It does rely on a model that sort of looks at stipulations in laws or regulation, and whether you have restrictions that limit the sort of use of an asset or conditions on it. And so the challenges that come up really have to do with first working out whether it is an exchange transaction and you sort of end up in the revenue accounting versus a non-exchange transaction. Lots of different gray areas in working that out. And then some specific issues such as tripartite arrangements, which don't meet the definition of an exchange, but they're also not a direct transaction. So there's sort of some quirks like that. Of course, grants and these type of transactions tend to be pretty messy and bespoke, just like we were talking before, and that comes into it. So I think it's probably fair to say that the transactions that are giving rise to these challenges and the wide judgments that need to be made, the wide grey areas are very similar, but I think you can see, dare I say, a little bit more specificity in how the standard actually creates a conceptual framework around that. 23 that was, and then 47 sort of even takes that a bit further. So there's, I think, helpful aspects there that I don't know if they could inform guidance maybe that we could draw from in how 1058 is applied, but certainly something worth learning from, but definitely not the silver bullet that we're looking for.
Thank you, Amir. That's a very good insight. And yes, so absolutely, it is on our monitoring list. So staff will certainly keep an eye on this, and we are also looking forward to seeing how that pans out in New Zealand, and then bring that back to the board at some stage, but not in the near future. Now, one of the things that we also wanted to highlight was some of the changes that are forthcoming exposure drafts, standards, requirements. And one of them is forthcoming AASB 18, presentation of financial statements. And under that standard, we have to categorize revenue as either operating, investing, or financing. And these categories differ from those from the cash flow statement. So I guess one of the challenges here will be for affected entities to categorize their grants revenue. And so in the for-profit sector, we haven't really heard much about this, but for the not-for-profit sector, that is a bit different. So in the public sector, the board has decided that the categorization will not apply, or there's relief from that categorization, and that is mainly to do with that the public sector has a separate presentation requirement, the Uniform Presentation Framework, Government Finance Statistics. But at this point in time, the board is working through how not-for-profit private sector entities and also universities might consider grants. And there is an ED forthcoming towards the end of the year, possibly, that where those entities will then have an opportunity to consider how this will look like. And provide their feedback in that regard. So that is something that will be forthcoming for those in the audience who are in those entities. And of course, we also have our Tier 3 standard, AASB 1061, which again has actually a very different recognition criteria. Right, so this is really for those smaller entities in the not-for-profit sector. It's a brand new standard that's just been published by the AASB. So if you are a not-for-profit public sector, a not-for-profit private sector entity that is not required to do Tier 1 or Tier 2 reporting, that might be of interest to you. And in that standard, the criteria to recognize revenue or to recognize deferred revenue is when there's a common understanding between the entity and the transferor. So this is much less specific than the requirements that we have for revenue recognition in AASB 1058. Now, I've had an audience question about from a recipient and about the acquittal process. So the question was, hang on, let me find it. For acquittal report submitted to federal government for grants funding uses, what base should be used, cash base or accrual base? And should it be aligned with the organization who receives the government grant or aligned with the federal government requirements? Michelle, would you be able to address this question?
Sure, thanks, Sabine. So an acquittal report should be speaking to what is required to be requested in the grant agreement. So it should be based on whatever framework you've been provided for in that grant agreement. It isn't dependent on what your accounting policies are more generally when you're doing other sorts of financial statements. If it's not particularly clear from that grant agreement what the accounting basis should be, I would suggest contacting the grant provider and seeking some clarification as to what their intentions are there. But what is also important is, particularly when your acquittal report is going to have some sort of assurance provided over it, so audited, for example, it's important to disclose in your acquittal report the accounting basis that you've used in providing that information. And certainly if you're having an auditor's report done over that acquittal, that auditor's report will want to be pointing to the accounting policies and making explicit reference to where it has been disclosed, on what basis that acquittal information has been provided.
Thank you very much, Michelle. Yes, I encourage the audience to provide any questions. One of the things that I also wanted to mention is that with the AASB 1061, the Tier 3 standard, we actually have created a knowledge hub on the AASB website if anyone's got questions for that standard. So please check out the AASB 1061 knowledge hub on our website. I think apart from that, we've covered a whole lot of information. One of the questions related with Tier 3 could be, should something like a different recognition and measurement requirement be available to the public sector? Because so we've got it for the private sector now. Should that also be available for the public sector? Anyone? Michelle, I'll start with you.
I'm happy to take that question. I think there needs to be some more work to understand what value there is in a tier 3. It is, it is a point to consider going forward. We have tier 1, we have tier 2, and we now have tier 3 for the not-for-profit private sector. So over time, we can expect the existence of a tier 3 to have some influence as to what the tier 2 requirements might be. So I think it's worth keeping in mind and monitoring what that looks like for the smaller entities, whether it's in the public sector or the for-profit sector, which the non-charity sector, in terms of the absence of a tier 3 and what that might mean for development of standards going forward. In terms of whether the recognition and measurement should be different, I think that again there is work needed to understand what the needs are there from a user's perspective, but also from a public sector preparation perspective. I suspect that there is varied practice around Australia as to whether or not accounts of very small entities are prepared on the ledger of larger entities, and whether therefore there might be some desire to retain full recognition and measurement principles, or whether there is sufficient need for entities which are effectively standalone and would benefit from the far simpler development of accounting policies and perhaps that not quite so technical detail needing to be applied to transactions. So I think there's room there to understand the need better before determining where to head.
Yes, thank you, Michelle. And again, that was also a topic that was discussed as part of the AASB agenda consultation, and staff will be collecting information. As you said, more work needs to be done to really understand what the needs of those entities are, and how this can sit within a wider public sector framework, financial reporting framework, really. Now, I think so. We've had one question: how upfront grant payments should be recognized under the revenue standard. Now, I might just say that we cannot give and provide technical advice here, really, and that would really depend very much on the specifics of that grant payment, which again leads us to the conversation about how much professional judgment is involved in those decisions, and recognizing that this is not really an easy standard or easy standards to apply.
I'm happy to jump in on that one.
Yeah.
But it'd help. I guess that's a good question and kind of sums up everything we've been discussing, where if it's a genuine grant, which means you've just been granted these funds, it's not in return for anything back. It's not an exchange, then that'll be different standards that you're ending up in, not the revenue standard, but the standards that deal with grants. And the accounting there mostly just gets you to recognize that ASAP as soon as possible. And so it does make your accounting statements pretty bumpy potentially, depending on when and how much of your income relates to those sort of grants. But therein lies the real issue. How do you work out whether it genuinely is a grant which is received without a reciprocation? And we've heard multiple different attempts at sort of setting some criteria around that in different standards that we've talked about tonight, whether that's the IPSAS standards, the various 120, 1058. These are all different attempts at doing the same thing, at kind of specifying and putting enough, I guess, bones around it so that you can actually land on how to account. However, I think the conclusion is you really can't do that in a standard because these grants have so many different wild and wonderful forms. And so the more you try to standardize, the more difficult it is to apply the standards. And you end up with really professional judgment, and it is very challenging. So that'd be my answer, but please don't take that as accounting advice.
Thank you, Amir. Freddie.
Now, thanks. I absolutely agree with Amir, and absolutely would not be providing accounting advice, facts and circumstances, and always. I do think that the landscape has changed since we looked at Appendix F215 and 1058, and now I know they are working. But obviously now we have IPSAS New Zealand adopted it, AASB 120 survived test, FASB used as an inspiration, and also there is a grant, capital grants as a almost conceptual exemption, if you want, in 1058 proper, right? So it does a little bit pose a question to monitor how the other standards, which are pretty much looking at not necessarily recognizing upfront in absence of sufficiently specific performance obligations, but trying to align it with the delivery of the purpose of that grant. And obviously tier 3 is simplified, but it is something to ponder for the standard setters. And maybe if AASB will refresh 20 and will not necessarily depart too much from where it is now, that would actually signal that potentially it can work even under current conceptual framework somehow, maybe with some tinkering around the edges.
Thank you, Freddie. Yes, so again, I think it is very important to recognize all the challenges that we have with applying the standards, including which standards we are finding ourselves in. And we've had another question about how this will look like under AASB 18. And again, if you are not for profit entity in the private sector, then there is an ED forthcoming. So we do not have the answers. And I'm sure that even when we have a standard, there will be some tinkering around the edges once it becomes effective, and how it will then be applied. And as usual, it will be subject to that professional judgment and the specific circumstances of each interaction and transaction. Freddie, do you still have your hands up, or? Yeah. Okay.
But 18, going back to what comments Martin made earlier, also obviously 18 does bring that additional value and guidance around aggregation, disaggregation and labeling. So before we go into kind of not for profit specific potential future amendments and guidance, it should also help and to boost if there were entities, for example, not necessarily disclosing and calling things as they should, maybe applying 120 or otherwise. 18 is there to actually address some of these things, providing more guidance and more specific guidance, still principally based to how to aggregate, disaggregate, how to use the word other or actually not use the word other, etc. So that should be some value add as well. Thanks.
Thank you. Yeah, thank you, Freddie. Very good point. I might take this one last question. So the question was, is a grant different to a donation or a gift? Now, of course, if you are as a for-profit entity, we are speaking specifically about government grants under AASB 120. Under AASB 1058, would anyone like to comment? Yeah, Freddie.
Yeah, I can take that on, because if I'm not wrong, there is a reason why 1058 and 15 are actually using the transactions where the entity received the asset it's essentially lower than its fair value, or to achieve that benefit. That it actually is the wording that is used to not to then need to distinguish between grant, gift, donation, but it's really about the characteristics of the transaction and whether they are coming with a sufficiently specific performance obligations, conditions, restrictions, and other clauses, including termination for convenience, etc., and taking aside what is the actual label on the agreement or how the transaction is labeled.
Thank you. And Michelle, and I think you wanted to...
just a similar thought there that, the existence of the word grant on an agreement won't dictate the accounting treatment. And so particularly you might see things referred to as grants when they are effectively contracts with customers for the recipient. So I would encourage outside of that, in the not-for-profit space, that it's going to depend on the substance of the transaction rather than how that looks and whether it's a donation or something else.
Yeah, excellent points. Thank you very much. I think that is all we've got for today. Thank you very much to the panel and to our researcher, Dr. Wei Shi. Again, for the audience, if you do have any questions, please always feel free to contact us at standard@aasb.gov.au. And as I mentioned at the start, we will make this session available on the AASB website in due course. Also, thank you again to CPA Australia and CAANZ. And I will leave it here for today. And have a wonderful evening, everybody. Thank you.